Hi, I'm Ross Mayfield, Investment Strategy Analyst at Baird, and we are back for another weekly video with our friends at Strategas. I'm thrilled to be joined today by Washington Research Analyst Jeannette Lowe. Jeannette, how are you doing today?
I'm great. How are you, Russ?
I'm doing really well. Thanks for joining us. I would say it's fortuitous to have you here because there's a lot going on in Washington, but that always seems to be the case. The big news, Build Back Better, has kind of hit the skids. That's the key landmark legislation from the current administration. So let's just get your quick update on Build Back Better and where we stand today.
Absolutely. So this has definitely been an issue that's taken over Washington for the past couple of months. The House passed a version of this Build Back Better spending package in November. It's still a pretty large package. And what you saw is that Senator Manchin from West Virginia said that he couldn't support the package in its current form. And he's been citing inflation as one of the key reasons why he can't do that. And he's going to focus on trying to cut down the package and have the spending that gets included match up to the tax increases that are also included. So essentially that the bill would be paid for essentially. So that is going to be what the focus is now going to have to be. They are going to have to cut down the size of the package, focus on just a few key priorities. We think that that's going to be spending for climate and green energy, funding to continue the expansion of the Affordable Care Act or the healthcare subsidies, maybe something for a universal pre-kindergarten or something along those lines, but it's going to have to be much more focused than it has been in the past. The other thing, though, is inflation is still going to be a headwind for this bill's passage. So we could still have high inflation readings in February and March, and that could impact when this bill gets passed. It might push out the date even further. And so what's going to be important with that is we have to think about those tax increases that are also part of this package. The original passed bill had the tax increases, so the 3.8% additional tax on small businesses and that wealth surtax, those were supposed to go into effect in January of this year. And so the longer this bill takes to get passed, the less likely we think that they could actually make those tax changes retroactive to January 1st. So that might push it back out to, let's say, April or something later in the year. And same thing for the corporate side. So there's supposed to be a new corporate minimum tax that goes into effect in 2023. There's supposed to be additional changes to international taxes for multinational corporations. And again, the longer this bill takes to get passed, we think it's likely that they might have to then push out the effective date of those tax increases to maybe 2024 or something like that.
That makes a lot of sense. So less spending, but potentially less taxes in the near term as well, and we'll see how it develops from here. You did mention inflation a handful of times. It's obviously the key talking point in markets in Washington. And that brings the Fed off the sidelines. So we're going to see tighter monetary policy in addition to tighter fiscal policy. And that seems like a lot for the market to digest. What are your thoughts there?
Yeah, absolutely. So again, we're going to see, we had unprecedented fiscal and monetary support for the US economy during the pandemic in 2020 and in 2021. And that's rolling off. We're seeing actually that the economy is in very good shape. We've had really good tax revenues, which has actually been quite helpful to the US government and the budget deficit. So one of the things that we're actually going to see is the US budget deficit is going to come down considerably. So it's going to actually decrease by about 9% of GDP this year, which is something that we haven't seen since the drawdown of World War II in 1946. So that's going to have a big impact. And then the Fed also looking to raise rates to fight high inflation. All of that's going to kind of come to play on the federal side. And so you're going to see a tightening you're not going to see much more stimulus coming out of the federal government. Yeah, there's talk about maybe they could do a small package for either like restaurant aid or, entertainment venues or something like that. But the scale of what that would be compared to what we've seen is not comparable. So there's going to be kind of this fiscal drag that we're going to see in 2022. And on top of that, then you have the federal, so that you have the monetary policy tightening as well, with the Fed looking to raise interest rates. So all of that's going to kind of come into play this year, which will be important, have an impact on the US dollar as well. When we're kind of coming on the anniversary of what we've seen of the high budget deficits from the COVID pandemic. So that's going to ultimately lead to the dollar going down. But then the other kind of interesting story to this is that the states are actually in great fiscal shape. So the states are also benefiting from high tax revenues, just like the federal government is. And the federal government provided all this COVID aid to the states, which actually paid many of their expenses during the pandemic. So states are essentially flush with cash. And so the interesting dynamic that you could see on that side is that governors, and the majority of them are actually up for re-election in 2022, they're going to be looking to maybe do some tax cuts, maybe try to fight inflation at the state level, maybe put into place some new spending programs. So you're going to kind of see this different dichotomy, what's happening on the federal level versus what happens on the state level.
That's a good note. So maybe a little fiscal support after all. Okay, I want to end here. You all have written about this before, but we are in a midterm year. That has historically meant heightened volatility in the stock market, but it also has meant a historic buying opportunity. So could you talk about what a midterm election year looks like for the stock market versus years 1, 3, or 4 of a presidential term?
Right. So we generally see the stock market being much more volatile in a midterm election year than a non-midterm election year. And so what we usually see is the average S&P 500 intra-year decline in a midterm election year is 19%, whereas it's 13% in a non-midterm election year. And that happens for a couple of reasons. First, presidents tend to lose seats in Congress during a midterm election year. So they try to motivate their base ahead of the election, and they usually lean into policies that tend to be anti-growth. And then the second thing is that investors try to anticipate what might happen with a change in political control after the election. But ultimately, even though we might see more volatility in a midterm election year, it's still a good buying opportunity because we find that stocks are actually up in the year after the bottom by an average of 32%. And in fact, we have not seen the S&P 500 decline in the 12 months following a midterm election year since 1946. So while we could see more volatility, it's definitely still a great buying opportunity for stocks.
Well, we love to hear that. Well, let's end on that positive note then, because that's something to look forward to. Jeannette, thanks so much for your insight. Thanks so much for your time. And we look forward to speaking to you again sometime later this year.
Thank you so much. Appreciate it.